Hello guys. Welcome to my channel. So today I decided that we are going to work on a new project using Python, and what exactly we are going to do now is to try and find out, do some exploratory data analysis on exploratory data on oil. It's better to create a virtual environment for your project. The reason why we create a virtual environment is because you need to think about it as a sandbox where you install packages without affecting your system. So sometimes you may have to install some packages or even upgrade some of them or use some packages. So the reason why we create our environment is to make sure that you are able to separate this work from your other work to so that it does not affect some of the dependencies. When we talk about dependencies, um, the pro- the the libraries and all that without affecting them. So uh, this I would say is optional. It will still work. It's optional, but as a good practice, you need to keep your projects clean and then the dependencies should be isolated. So I'll go quick and go straight to the reason for it. So we need to mail. So this is how I decide to call my project. So this code here is going to install um, the virtual environment for you. And this is the name I have decided to give my project. So usually it's preferable to do this in VS Code, but I'm going to do everything here because I'm not going to install the virtual environment. If you need a video on that, you can check my other videos. So uh, now that we've created it, we need to activate. We need to activate. So it will tell you that it is an invalid syntax because um, this is not VS Code and it's not going to give you uh, the, the, the work you need. So what we are going to do is we will just jump straight into it without install numpy as np, and this is also for maths. So the pandas is for data frames and all that. Then the numpy is basically for maths. And then I will go ahead and import my help us with so I got my data from the EIA website. So the EIA is a very good site if you're looking for a reliable source of data for your oil and gas projects. That is the that is a very reliable source that you can get your data. So yeah, gonna import that. I have the bear with me. I think I have. Yeah, so the reason why I'm copying this is just to make sure that you understand. So we load the data, assume that the Brent CSV has column dates. So with the data, See if I can get the data for you guys. So you need to get the data loaded. That is something I probably should have told you. So you need to get a data loaded. So I'm going to do this step by step so that you understand what I mean. So first of all, we need to create our data frame using the pandas. Let me bring this here. Forgive me, try and follow. So we've imported our libraries. Now we are going to import our data. So the DF is just for the data frame. So we are calling our data frame df, and then the pd.read underscore csv means that we are using pandas. What we define here, we are using pandas to read our CSV file. And for my CSV file, you may have it different. So this is the name I stored. This is the name of the file I stored. So it's Europe Brent, Europe underscore Brent underscore spot price FOB.CSV. You could just keep it simple by renaming it to Brent.cv. And on my laptop, I have it in the D drive, and it's in a folder called the ML project because I'm trying to work on a machine learning project. So this is just one of like the start of the project. That's why I have it as ML project. So yours might be different, but you just need to make sure that you copy the path and then you put them here. Then this path is to make sure that assuming that we have dates. So if we because of the dates in the data, we just want to tell pandas to treat the date column as a date time, so that it doesn't show as a string or um, any other data type. So that's why we pass the data as date so that it does not misbehave when we are trying to call it as a date. And so after we've done that, just to give you an idea of what the data it looks like, I'll call the df, and this is the data I have my CSV file. So I have the date here, and I have the price that is in dollars per barrel. So for 2025, on the 22nd of August 2025, we have the price at $68 and 29 $68.29 per barrel, 21st of August. So it follows through, and that's how our data look like. So I'll go ahead and delete this because we need to work on this data. So the next thing I'm going to do is I'm going to try and sort this data chronologically. What do I mean by that? I'm going to remove this old index, and then because I'm not able to go through all the data, but I just want to make sure that the data follows through chronologically. That is, there shouldn't be any situation where you have 20th of May 1987 here, and then you come and find 22nd here, and then 26th somewhere. I just want to make sure they follow in chronological order. It doesn't hurt if they are already, but as a data analyst, it's part of the cleaning process. You need to make sure everything is okay because the data you feed into the system is going to generate your insight. So you want to make sure you got everything right. So we are going to call our DF and say that let's sort this DF. Okay. So we are going to sort. So sort underscore values. So we are saying that what we are saying is that this is our DF and we've already called it. So when we called it, you saw this. So we are going to say that with this DF, sort this original DF. So this DF will refer to this. So it's like a global variable. So we are going to sort the values in this DF. But are we sorting all the values? Because if we sort the prices, it's going to sort it based on this. So we need to specify what should we use to sort. Then we need to specify, okay, so sort with a date. And the date, you need to make sure that um, if you need to make sure how yours is spelled. So here it is capital DATE. You need to make sure it's the same because in Python it takes care of it's very sensitive to how the the um the fate. So we are going to say this one is telling us that we are creating a figure. Yeah, we are creating a figure. So when we were importing, we imported the Matplotlib pyplot that is for the visualization. So we need to indicate our axis. In modern data, it's better to use a Seaborn, but I just decided to use this. I can also use the Seaborn, but I don't want to complicate things. Is if for a final project, I would use the Seaborn definitely because it gives a very nice view of your data. All right, so yes, let's go on. So we need to create the axis. We need to define our axis and know where our axis will be. So we need to create a figure with two. Um, I want us to create a figure with two subplots stacked vertically to each other. So just to make use of the space, I want to create a situation where we are going to create two charts. So with the charts, we are going to create one with these prices and then another one with the log returns. The idea is that with these prices, it will give us a linear relationship between the years and the prices. And then I will create another chart where we find the difference between the relationship between the years and the log returns. This will give us an idea of, so this is giving us the percentage change, but this is giving us the real figure itself. So if it jumped from here to here, we will say, okay, it increased from by this number, it increased by 0 0.5, 0 0.5, 0.3, reduced by 0.3 and all that, 0.03. But here is telling us about the difference. So this is about 0.9% change. So what does it mean? We need to plot two different graphs. So I'm going to tell Matplotlib, so we call PLT, and then tell him that give me two subplots. So we are talking to Python. Give me two subplots. And with these two subplots, let's indicate I need to plot another one, which will be our DF. Let's call it here. So DF price. Usually I prefer to copy. Yeah. So then bring that here. Yeah. So all that we've done here is that we are saying that we are going to plot this. And by plotting this, we are plotting the date and then the price per dollar for the first one. So we get date and then the price per dollar. Yep. Voila, there we go. This doesn't look presentable with, these here. Doesn't look presentable. So we need to make sure it's presentable. The reason why I run it is to give you a fair idea of what is going to be. So we have our dates and then we have our prices here. We need to give it some form of a title to make it look nice. So we will go ahead and say for axis 0. So that is for this one. For axis 0, what should we do? Set title. So we are telling to set a title. And what title should we give this? Let's say trend of Brent, our y-axis. So what should be our y-axis? So DF, and our y-axis should be the log return. So if you're not sure, you can go and copy it and come bring it here because it should be case sensitive. Otherwise, it's going to give you an error. Okay, so now we got it like the way we did over here. Just let's copy to make it faster. We can give it a title. So what title should we give this? Let's say the log returns. Did I give it log return here? Yeah, let's do it. Log return. Print log returns. Brilliant. Let's see how it looks. Yeah. Okay, so at least we've had some visuals for the data. This is looking good already. So we've also plotted our log returns over time. So this, because it's percentages, this is giving us the so for each price, or for each year we have the actual prices, but this is giving us the log return, which is the percentage changes. So we can see that over here the it's like someone would say it looks like, you know, those. I had a friend who DJ Fortune DJ. He was always doing music. He's into music production. Someone would say this looks like a music, you know. Yeah. So I've actually forgotten how they call it, but it looks like some form of a frequency. So the whole idea is to know that, you know, prices remain relatively um stable for within this period. So you see there are spikes, down 10 and up 10 spikes somewhere here, which is reflecting the years where there were changes. So this is giving us the percentage change. We will come to the analysis. So let's just try and finish with this, and then you know, I'm trying to make it presentable because we don't want to have all these things here, and you know, you need to make it more presentable. So let's just do a little alteration here. So let's do a bit of what can I do here? Print log returns no. So I made a mistake here. It should be 1. Yeah, I didn't change it. Okay. Yeah. So we still have our brands. So now we can see here. It looks like the difference, the gap between these two is too close. So what I'm going to do is I need to try and separate them, create some form of spacing to so that the title and the answers do not overlap. So let's do this. We use the PLT because that's for the plot, and then you say that tight layout. Just say tight layout. Yep, and then we at least, yeah, we've seen that there's some form of a gap here, better, looking better than it used to. And then let's use our almighty show. So whenever you are done, you need to use this to make it more presentable. There we go. Yeah, so we have our data. We've been able to, so here we've been able to plot our data, and then we've been able to identify the trends when it comes to the price, and then the log returns and all that. So let's try and make sense out of it, because if we draw this, anyone can draw this, but what does it mean? What is the essence of this whole thing here? So with this price plot, this one here, it shows the long-term trends. So there's an upward trend, and then a downward trend, and then we also have some form of stability in sometimes, and the log return plot also gives us the short-term dynamics. There are some spikes here, and there were crashes here. Here we had a crash here, a little spike, a little spike, a little crash, a little spike, crash. And here we had a very high spike and crash here, which was in 2020, probably due to the COVID. Yeah. So together they give us a complete picture of the market. It gives us a very complete picture of the market behavior of the. But let's do this final one here, and then we will go into the analysis better. So let's try and see with this one. I'm interested. Let's try and understand, because it doesn't just make sense to say that there was a spike here and there was all that. We can use the describe. So let's do df. So let's try and describe this one. We want to know the statistical meaning of that. So let's call the log things. So what does that give us? Oops, no, I made a mistake here. I need to call the describe. That's the main reason why we came here. And this has to go. Yes. Yep, we are printing the whole thing. So yeah, voila. Oops. I think I made a mistake with the log with things. I think I made a mistake. So that's what I always tell you. So this is log return, not S, but I added the S. So that's why it's always better to just copy and paste it. Anyway, we found it. So that's part of the analysis. Yeah. So this is what I was looking for. This gives us a count of the number of data and all that. We will come to all that. So now at least we have these charts, and then we have the summary of the results. The count will give us the number of data points that we used. The mean gives us the average return, that is a tens of S of the averages. The standard deviation is usually used to represent volatility in the system, in the market. So it gives us the level of volatility. There we have the minimum and the maximum. So it's always better to understand, no matter how high or low it goes, what is the maximum and the minimum it can go in terms of percentage. So that's the essence of that. We have the quartiles, then we have our median, the 75% and all that. Okay, so we want to know that 25% of the data are below 1%, negative 1% and all that. Yeah, okay. So now here is the part where we need to talk like analysts. So it's not just about drawing the tables and um, typing the codes. The difference between you and AI is your ability to make sense of the data. So let's try and understand it. Let's try and understand the data. Okay, so with this, let's start with the trend of Brent price, this chart. So here, between this period, so this is 1990 to 1999. So over this period, we can see a bit of a spike here in the 1991. So as a data analyst, what you can do is you need to research and see, were there any events happening in this period, 1991? I cannot recall it on the top of my head, but I think there was something related to the there was, okay, I don't remember on the top of my head, but if you compare this period to this period, we can say that between this 1987, that is when our data started, to say 1999, the prices were relatively stable. And there was a Cold War before this period. So after the Cold War, prices were relatively stable. Um, and because there was steady supply, and then there were some economic adjustments taking place as well. So prices were relatively stable. Now, from this 2000 here, we can see that the prices started rising. It rose, fell a little, became a bit stable, rose again, fell gradually, and then started rising all over again. So between this 2000 and this side, this will be somewhere 2009, 2008. So 2008, we all remember there was this global financial crisis happening. But from this period to that point, we can say that there was a dramatic rise, and this within this period there was the rapid industrialization taking place, especially in China. So there was a tightening supply, and then there were some geopolitical tensions as well over this period. Uh, yeah, so all those things could account for the increases in the prices. Um, so within in 2008, the prices went skyrocketed just before the global financial crisis happened, and it fell again when the crisis actually happened in 2009. And then in 2009, there was a recovery, and then there was another surge, which was driven by the demand rebound, because at that point, people were putting things together, and demand started coming up, and there were some decisions by OPEC as well to uh, kind of limit their production, cut production, and all that. So between 2009 and 2014, there were mixed reactions where there were some cuts in supply, there were demand was rising and all that. So prices rose, stabilized, and then began to fall again in up to 2014. So it fell in 2014, and then in 2014 there was another recovery. There was there was a sharp drop from, I think it was in 2013. Yeah. So there was a sharp drop, and then uh there was a sharp drop. I think in this period the shale, so I'm just saying this on top of my head, but if I were to do the analysis, I would look for this period, the major events that happened in this period. And I think in this period, what I remember from my energy economics class was that the shale production, US shale production revolution started somewhere in 2014. So uh, it caused there was an increase in supply of oil. So usually when there's an increase in supply, there will be a drop in price. So there was a sharp drop here due to the shale revolution in the US, which flooded the market with supply. And this disrupted the traditional price and power. So it caused a major drop in the prices until the 2016, somewhere in 2016, when the market was able to now adjust to this new trend. And then the prices started going up now again. And then it started going up, but not by much. So in 2020, then the COVID hit, And that was the historic crash where prices even went to negatives, zeros and all that. So this was very historic. So we could tie this to the pandemic because global demand collapsed and oil briefly traded at negative prices in this place, in this era where people, one thing about oil and gas is that when production starts, it's not like a tap where you just go and then switch it off. You need to keep producing. So at this point, the production was still ongoing, but demand was very low. So the prices had to drop. And it takes time for um, the supply to adjust to the market conditions. That's one thing about oil supply. So if there is even if there is let's say geopolitical tension, the sudden price changes, the short-term price changes is not based on the demand and supply themselves. They are based on speculations. The demand and supply kicks in when the demand and supply kick in when after some time when they've been able to adjust their production capacities and all that. So it's a very tricky thing when it comes to the demand and supply of oil and gas. So let's go on. So COVID hit and then the prices fell dramatically and then began to rise a little somewhere in 2020, 2021, 2022. Uh, so there was some recoveries. Inflation was high because most of the governments had to spend a lot during the COVID period. So, COVID took about 2 years for countries to recover. Even in 2022, there were a lot of countries that were still recovering. So there was an increase in the price due to the rebound and uh, the post-pandemic recovery. There were inflationary pressures, and then you know geopolitical disruptions also happened. It was around 2022, I think in February. That was when Ukraine, the Russia and the Ukraine war started. So all these factors, Russia is also a major supplier of oil and gas. They supply Europe and other countries, many other countries. Uh, so yeah, so it also caused the prices to continue to rise. And then there were sanctions and all that. And then the US productions and all that came in. So Russia was not able to produce and supply as much as they could. And then it started falling. And we are in 2025 now. Now, currently, it rises and falls, rises and falls. It's never stable. But, you know, oil and gas is never going to be a straight line like this. It's always going to be volatile. So even in this period, I would say it has been stable for some time now, um, compared to the previous periods. Yeah, so now let's come to this. With the log returns, this kind of give us a beat. Like I said, it looks like a music beat. It's like it gives us that emotional intensity of the market. So we can see here. So anytime you see a spike in the long returns, it indicates that these are times of extreme price movement. So if you see this spike, it means there was an extreme price movement, either by panic selling or euphoric buying. And most of these, anyone who has done economics in energy economics will tell you that price is determined by demand and supply. But one of the major players, even in financial markets, one of the major players or the determinants is the speculation, the speculators. There are people who buy millions of gallons of oil and they have no storage facility for them. They are only speculating and trading, and they are very influential when it comes to um, manipulating, not manipulating. They are very influential when it comes to uh, affecting the price of oil. So sometimes, assuming we expect the war a war between Iran and Israel, and as a result of that, production still remains the same. There are no disruptions. Um, I remembered when the war between Iran and Israel started, people were speculating that the Strait of Hormuz will be closed, which to me, I knew right from the beginning that would be a shoot in the foot, a shot in the foot if Iran had gone ahead to do that, because it is their also it's one of their lifeline, because they do a lot of transaction go on in that strait, so they wouldn't do it. But there were a lot of speculations and people kept buying, and it's caused prices to increase and all that. So that increase was not based on the demand or the supply. It was actually based on people's speculations, their emotional attachment or emotional reaction to the market event happening. So, based on this explanation, let's be quick with this. So, like I said, the spikes indicate price movements, and usually it tells you about a short term. So this one tells you about a short term. So you see, if we talk about this one, it's like from 2023 to 2020, 2000 and let's say 2008 to 2009, 2010. Um, but that is a very long time. But this one usually gives you the short term spikes. So in the 1990, there was a spike. There was this spike was possibly tied to the Gulf War, which disrupted oil supply and then triggered market fear. So due to the fear, a lot of people started buying. Um, you know, they started buying. So when the demand is high, obviously prices will go up. So yeah, um, and then due to the war, there was supply disruptions and all that. So this triggered fear. Then there was this spike, and then there was another spike in the 2008. This was a spike, but not much. This was in the 2000s. Um, So this was just out of the revolution, and this was the time where China started demanding a lot of oil. So this could be, one of those events happening. You can understand it better when we have the days and all that. And there was this place as well, 2008, 2009, there was another spike. This was caused by the financial crisis, where there was a lot of uncertainty. So um, most of the companies, speculators also kept buying and selling and all that. So um, there were a lot of uncertainties in all asset classes. So some would sell because they believe that there was going to be a crash in the oil market or anything. Others also sold, others also bought a lot because they knew the opportunities were coming. So yeah, that was it. And then we come to the 2020, the COVID crash caused this crash happening, and once in a century demand shock, and then there was a demand shock here, so it caused that spike. And then after the 2020, there was a continued volatility. You can see there was a volatility showing that the market hasn't returned to pre-pandemic claim calm here. So this could be for this part is due to inflation and energy transition uncertainties, geopolitical instability, like in the UK. UK is very ambitious when it comes to the uh, the energy transition agenda, and the US recently declared drill baby drill and all that. So yeah, they are all part of the uncertainties, and so you can see that there are short-term spikes, but not too much. So yeah. So what exactly is the bigger story? So together, these two plots tell us a story of booms and busts driven by macroeconomic cycles. So there could be these cycles are based on macroeconomic factors happening sometimes out of our control, geopolitical tensions and all that. So here we have the Gulf War happening. We have the Russia-Ukraine war, the COVID happened, all these factors are very influential when it comes to the prices, just like the price of any other commodity. We also have structural shifts like the shale oil and energy transition happening along the way, which caused the prices to spike, and then the global crisis that rippled through commodity markets, like the financial crisis and all those things. In all, we can see that the market is not just volatile, but deeply reactive to human events. And that is why oil remains one of the most watched and traded commodities. It's a mirror of global stability, conflict, and transformation. Um, because anything happening in the economy can be um, traced by looking at the oil prices. Let's try and wrap up. So here I did this specifically to give us a summary of what we've done so far. So we have the count as the 9,708. So that's the number of daily log return observations that we did. So it suggests a data set spanning around I think about 38 years. Yes. Yeah. I think it's about 38. Yeah, that should be about 38. So I think yeah. Yes, of trading. So it's about 38 years of trading days. Because usually we assume that the trading day is about 252 days per year. So that should give us about 38 years of trading days. That's a lot for to give us a fair idea of how the market reacts to changes in economic factors. And this gives us the mean. So the average daily log return is slightly positive. It's about 0.0, I think 0.001% or 0.00034. So it's slightly positive, indicating a very modest upward drift in prices over time. So it means that on average, prices drift upwards, but it's slightly positive. It doesn't drift too high. So it's nearly zero, suggesting that most of the price movement is just noise or volatility, but it doesn't follow a particular trend. So that's what this means. And then it also gives us the standard deviation. So the standard deviation is, like I said earlier, is just the volatility of the daily returns. So since this data is a daily return, the daily data, this standard deviation gives us the volatility of these daily returns. So the standard deviation of about 0.025 is about 2.5%. It means that prices typically fluctuate about 2.5% upwards or 2.5% downwards. That's plus or minus 2.5% every day. So for crude oil, this is moderate to high volatility. It's reflecting its sensitivity to geopolitical, economic, or supply demand shocks. So it means that um, with this volatility, it's trying to tell you that for anything happening in the economy, any shock at all happening within a day, the price is likely to go up or down by 2.5%. So if let's say you are a trader, what should you be looking at? How does this data, what is the essence of this data? It's trying to tell you that if you expect prices to go up, let's say there is a war and you are just a day trader, you can take advantage of this by saying that, okay, because of this war, prices will likely go up by 2.5% today within the day. So if you are just doing day trading, then you should bet, you should buy your options, um, buy your put options to make sure that you're able to sell it when the prices go up by 2.5%, and then sell it before it starts coming down, because all these noises are short term, like we saw in the meme. They are just short term. They don't last. Okay. So that's what the standard deviation means. So it reflects the sensitivity to this geopolitical, but it's likely to go up by 2.5% or less than 2.5%. And then it gives us the minimum here. So the worst single day log return, that is the on a worst day, on a very worst day, let's say on a worst day, the if prices were to drop, it will drop by 64%. So this will be this 64% is tied to a major um, market event, and this 64% could be lower, but it's 64%, which is very high, because with this that's the one thing about outliers. So we have this rising so high, and this one rising so high, this one rising low and more low, so in such a situation, when we are finding a minimum, it means we are saying that it will be able to drop about, if we strike a straight line between this, we are saying that if we are being neutral, then on a very worst day, to be able to drop about 64% downwards. And this is only possible through a major market event like the COVID-19 crash, or a geopolitical tension disruption, such as a extreme downside risk. But most of these risk is critical for risk management and hedging strategies for businesses that are into oil and gas products. Uh, we also have the maximum. So the best single day return, will be 41% surge. That is a 41% increase. And um, this could reflect a supply shock, war risk, premium, or OPEC decisions. So these upside spikes are very rare for you to see that in a single day the price has increased by 41%. But if it should happen, they are very impactful, because for price to rise that high is very impactful. And then we have the 25%, that is our first quartile. So it's only telling us that, so this is negative 0.011. It's only telling us that 25% of our daily returns are below negative 1.1%. Um, so in essence, to an ordinary person, we can say that it shows that the downside movement, whenever there is a movement downwards, they are very frequent. So about only 25% of our daily returns are below negative. The downside movements are very frequent. And so since we've talked about the 25%, let's talk about the 75 before we come to the 50%. So 75% of the returns. So we have our 25% of the return below negative 1.1%. So the remaining 75% are below positive 1.2%, meaning that large upward spikes are less common than the downward ones. So we hardly have high upward trends than the downward one. And um, now with the median, that is the 50%. We are only saying that if we should take everything and divide it by 2, the median return is slightly positive. That means the idea of a long term, it reinforces the idea of a long-term upward drift, because 50% of the time the price will be very low. It's slightly positive, so it means and it's very low, just slightly. So 50% of the time, it's if there's any shock, it's likely to go up or down. So yeah. Uh, so with a range between this minimum that is negative 64 and the maximum of 41%, it shows that Brent crude is very volatile because for it to go down, it can go down to about negative 64%, and it can also go up to about 41%. So the gap, usually if you are finding the interval, a confidence interval, we always want the confidence interval to be as small as possible. Because if it is very small, then we can confidently say that the data that we have we can use that to predict. But for an interval of between negative 64% and 40 positive 41%, it means it is very volatile. It's very difficult to predict how the oil price is going to be based on the data we have. And so the downward tail is longer and more extreme than the upside, and that is typical in commodities where supply disruption or demand collapses can cause sudden crashes. Yeah, so this there's a lot that we can talk about this. There's a lot we can talk about regarding these results that we have here, depending on the industry and the purpose of you studying this data. And with the mean, it's very interesting because it's near zero, it's almost zero. And it should also tell you that short-term speculation can be very risky, because in a short term, if you are speculating, then you need to really monitor the market. But if you are looking at it for in the long term, you may benefit from structural trends like inflation hedge, geopolitical premiums, and all that. So, with a very small average, is even though it's positive, it's telling you that short-term speculations can be risky. And with the minimum and the 25% and the 75%. The skew is on the upper quartile, which is the 75%. Is higher for the 75%. Um, so this is trying to tell us that there are some upward rallies. So there are occasionally um, the price tend to move upwards than downwards, and these are tied to macro events. So we also know that uh, oil prices are influenced not just by the demand and supply. Um, the demand and supply are the main factors, but these demand and supply are influenced by some factors like OPEC decisions, the geopolitical tensions, global demand cycles, sometimes even technological shift. Because when shale oil production came into effect, now US is the highest the highest oil producer due to this shale. Yeah, so these shifts can also cause disruptions in the market. And then there are some environmental policies and uh, like the UK ETS, emissions trading scheme. When you go to the EU has the EU emissions trading scheme, of which UK was part. I even have a whole project on the effect of the UK emissions trading scheme on investment decisions and decommissioning in the UKCS, that is the UK continental shelf, which came up with very strong findings. I'll present that later. But yeah, all these things can influence the uh, uh, the way prices increase or fall, and then yeah. Okay, so thank you guys for following through with this project. It's been something I've always wanted to discuss. I would welcome your comments and any other thing that you think I have not covered. There are interesting findings. Like I said, with data, you never finish working on data. There are so many things you can find with data. What makes it more interesting is my purpose for looking into a data may be different from the purpose for which you are looking into a data. So the same data set can be used to get different findings. So bear with me if I didn't cover something you wanted me to cover. I'll welcome any questions. You can put them in the comment section and I'll be happy to cover them. But apart from that, just wait for the next one. I have so many projects that I have to record them. I have so many projects that I'm now trying to publish them. And I promise you I'm going to um put all of them here because I remember when I was in school, I didn't have some of these things and some things became so difficult to um you know follow through. So I hope this helps someone out there. Um if there are any questions, please put them in the comment section. We are all learning together. I always learn. Like I said, I always want to learn something new. So if there's something I didn't point out, please let me know. And if there's something you enjoyed about the video, please let me know. And please remember to subscribe to this video so that I will be able to um, you'll be able to get the videos when I upload them. They will make no sense if no one is benefiting from it. So give me a like and let me know that you are actually benefiting from it. And that would mean a lot to me. So thank you so much, guys, for um, taking part of this journey with me. And thank you for um, sticking with me through to the end.